Short-term versus long-term VIX products. It's a really interesting piece. Let's see. Short-term versus long-term products. We're curious if there's any advantage to using shorter-term implied volatility instead of the regular 30-day VIX as a trading indicator for traders who work with short-term options. So in other words, so many people have been trading around short-term 0, 1 DT options that we're curious, hey, is there a reason to use a shorter-term VIX? So we want to test if there's any difference between the 9-day, the 30-day, the 3-month, and the 6-month VIX products offered by the CBOE. None of these are well, I mean, the 30-day you can trade. I don't think the 9-day, the 3-month or 6-month are even trading vehicles. Let's go next slide. But it's just for purposes of, do we get a better read on the markets? So the shorter term VIX tend to have wider ranges because they're more sensitive to market movements. And that makes sense. Longer term, everything can smooth out, but shorter term, you're going to get all the sensitivity. So again, the VIX is 30-day, and the other ones are all described by 9 days, 3 months, and 6 months. This is a pretty hard chart to read, but you can see. Well, I'm not sure how. You can see how the 9-day is the most volatile, because it's the orange. Sure. But other than that, everything kind of moves together. Let's go next slide. So these VIXs all have a high correlation against each other, but the correlations between the 9-day VIX and the longer ones, 3 and 6 months, are slightly weaker. And you can see that here. I mean, the VIX is going to have, with respect to the 9-day, it's basically going to have a really tight correlation. But once you get out, and you look at the 0.81 and 0.85, that's when you start to compare the 9-day to the 3-month and the 6-month. And remember, it's the same underlying. So it's not like sure. we're comparing. It's not like we're comparing the S&Ps to the Nasdaq or the S&Ps to the Russell or any of that kind of stuff. This is all S&P. So just showing you that duration will vary. The longer term durations will always hold this very high correlation. So the reason this is important, like if you're going out something like, let's say, 3 months or 6 months, and you're looking at different options, or 9 months, you're not going to get a lot of variance and decay because they're all going to be trading at right around the same volatility. Let's go next slide. Unless there's like an earnings or something else.
Sure.
So next, let's look into two things. How often is IV overstated compared to historical volatility? So how often is expected volatility overstated relative to historical volatility? We've always seen in the past it's around 85%, but we'll see. And what's the correlation between implied volatility, which is forward-looking, and historical volatility, which is backward-looking? Let's take a look. Because we're going to go ahead, next slide. So the 9-day VIX tends to be higher than the historical volatility 78% of the time. And their correlation is 0.88. So, and again, this is only comparing, 9-day volatility to historical volatility. And so I think that makes sense, that you're always going to find that the expectations of volatility are always going to be higher than what really happens, because that's how all volatility is priced. Because you can make limited but lose unlimited, so you have to have the implied volatility, basically, whatever percentage of the time it is. In this case, 78 is actually a little low to me, because normally it's about 85% time. When you're looking, this is 9-day versus the historical 9-day. Let's go next slide. So this is a 30-day VIX. It overstates 82% of the time, and the correlation is 0.82. That makes a little bit more sense, because that's a little bit closer to what we expect. But again, why is this important? Well, it's important for us because you want to know if you're selling front month, like 1, 2 days or 1 week options, like do I have more edge or less edge? And the answer is you probably have a little less edge. Because.
So you would agree with the bet saying longer term then?
Longer term what?
Well, you asked the question earlier, like, which one, gets it right more, the shorter term or the longer term? I think.
Well, it's not a question of getting it right more. It's a question of
you have more volatility swings for shorter period of times than the shorter.
100%. 100%.
It's
Because-
almost like looking at two different animals.
Yeah, because over the longer time frame, things will normalize. And let's go next slide. So the 3-month VIX overstates the HV 82% of the time, and the correlation though drops to 0.69. That's actually pretty interesting, because I'm surprised that the correlation drops so much when you go from three. I'm surprised the correlation drops so much when you talk about the implied and the historical, but it still overstates a ton. And go to the next slide. And the 3-month VIX. I'm sorry. This should be the 6-month VIX, and the 6-month VIX has the same overstatement ratio of 0.82, and the correlation is 0.64, the lowest of them all. So the longer you go out in time, the correlation breaks up a little bit, but the overstatement is the same. So basically, which you would expect. That's exactly what I'm saying. So the reason that you make these short premium trades is just that you're overstated 82% of the time. That's it. The question is then,
it's much more directional and biased too than it is strategic of selling volatility.
Yes, that is true. Let's go next slide. So implied volatility tends to be affected by investor sentiment, which could explain why short-term VIX they're more mirroring the real. They are more mirroring realized volatilities. Despite this, the amount that they overestimate is consistent no matter what the time period, meaning selling options overall still presents a strategic opportunity. I mean, it's taking a little liberty there, but the reality is that the overstatement is pretty consistent across the board. And although the correlations, they drop off a little bit as you go further out in time. So you're going to have higher correlations because obviously in the shorter time frame, you're always going to have higher correlations, but the overstatement stays consistent throughout. It's just good information. That's all.
You got one more?
Mm-hmm. Let's take a look. So since there's no significant difference between the short-term VIX and the regular VIX, traders can just stick to using the VIX as their daily trading indicator. Thank God, because last thing I wanted to do is start to use different VIXs, and like we try to make
simplify it.
We try to make complex option trading as simple as possible, and we don't want to give you like 6 different VIXs to look at. But people write to us all the time. They say, "What do you think about this 9-day VIX? What do you think about this 30? I'm sorry. What do you think about this 60-day or the 3-month or the 9-month?" And they ask us a lot of questions.
Or this.
Yeah, we just want to keep things simple. That's why we want to keep things IVR 30-day VIX. IV overstates historical volatility by a consistent percentage across varying time periods, highlighting the benefits of using or utilizing premium selling strategies. That's it.
Awesome. Let's take a quick 90-second break and come back. We got more Tasty Live with the opening bell next.